When you think about panics, many investors, they panic by putting all of their money into bond funds. Well, with the conflicting movement in the economy and housing and municipal bonds, how does one look at 2011 for the fixed income market? Well, my next guest is here to help us. He's an expert on the topic. Henley Smith, Chief Investment Officer at Commonwealth Asset Management. He's also the former Chief Investment Officer of Gabelli Fixed Income. Henley Smith, good to have you with us on Bloomberg.
Pimm, how are you?
Good, thanks. So what's the story with fixed income? I was just talking to Peter Coy at Bloomberg Business Week. He says, look, we've got this sell-off at the end of the year. Christian Thwaites yesterday from Sentinel Investments saying it's pretty typical. You do see this cleaning up of the books at the end of the year, so be a little bit cautious about drawing any big conclusions from the sell-off in bonds.
Yeah, we don't rush into December, and we basically take our time and let January come to us. And what we mean is exactly that. There is a lot of window dressing, a lot of balancing around in December that takes place. Markets are pretty thin, so I don't take a lot of the trading up. But yes, there has been a big sell-off in the bonds. Last time we spoke, I think, was when QE2 was announced, and 10-year notes measured by Treasury yields are up about 100 basis points.
Yeah, 3.4% right now if you loan your money to the government for 10 years.
Yeah, not bad, I guess, relative to where it was. But, yeah, on balance, the economics have been good, especially on the leading edge, consumer and manufacturing. Of course, in housing and on the employment situation is still a little dicey. But on the leading edge of the economy, we've seen some good numbers, and I think that's what's pushing up bond yields. And really the expectation of inflation coming back in 2011. I think that's what people are really feeling right at this point.
Now, I want to get your thoughts on an area that everybody knows about but doesn't seem to talk about. And this has to do with money market mutual funds, because there are some issues related to breaking the buck, and we know that that's in the back of everybody's mind. But some people even use these as bank accounts. What do we need to know about money market mutual funds in 2011?
Well, I think it's pretty much a pitfall in money market funds. I mean, there are some regulations that are being changed right now to make them safer, make them more transparent. One of the things that's going to happen in money market funds is Rule 2A7, which is the SEC rule that governs money market funds, is being revised to the fact that 30% of these money market fund portfolios are going to have to be in 7-day or less paper. So that's
very short term.
Very short term. So that's going to keep short-term rates relatively low. So those investors that have balances that are usually in a money market fund might want to look at another alternative to get better yields. But again, this is what's happening in the money market fund. Other changes that are going on, but I see it really as kind of a pitfall, because I think money that's going to be in money market funds is just going to be collecting dust for 2011.
So what should investors be mindful of in their fixed income portfolio? Is it about duration? Is it about how long you agree to lend your money, either to the government or to a particular corporation?
Well, that's always the key. Duration is what kind of measures the volatility in the market or a particular piece. We've been keeping our durations, fairly low, but we still think that the mattress matters. We still think people want to have liquidity, people still want to have safety, and they're willing to pay up to have that safety and liquidity. But we're also starting to see a little bit investors start to take some risk in terms of taking some more market risk, maybe in the equity markets or maybe longer-term bond positions, and more structural risk. One little nugget that I think is going to be good for 2011 is really to have some optionality on your bonds.
What does that mean?
Well, again, you could buy some agency pieces depending on the name, and if you buy a call option or sell a call option on that particular bond, you might get a little bit extra yield, still very safe, very short, but if you put some optionality on the bond, you're going to get a little bit better yield to it. So something, a little nugget for 2011 as we go forward. Are
there any nuggets for the municipal bond investor right now?
Well, I think that one is a real pitfall. I mean, obviously it's gotten a lot of news lately, but it's really specific. I mean, munis trade by appointment.
Right.
And they're not as if they're liquid like treasuries.
You can't make blanket statements about them.
No, you can't, because they trade, they're disjointed, it's municipality to municipality. And I think there's probably some good values there. Municipal funds, municipal bonds have backed up, and rates backed up about 100 basis points too. People thought that was a real safe investment. They were buying a lot of those municipal bonds in the summer. But with changes going on and with some supply conduits being cut off, specifically in the Build America bond program, those yields have risen very dramatically.
All right, we're going to leave it there, but I want to thank you very much. Wish you a happy new year. Henley Smith, Commonwealth Asset Management. Always appreciate your insight into the world of fixed income. Thank you.